2 million euros of profit, taxed at 25%. The real bill is 12,500 less, and it is not a mistake. IAS 12 is income taxes, and it is two standards in one. Current tax, what you actually owe this year. Deferred tax, what today's numbers commit you to owing later. Part 1 is the mechanics of both, ending on a full worked example. Part 2 covers where deferred tax actually comes from industry by industry and what is changing right now. Current tax is the amount actually payable to or recoverable from the tax authority for the period. If it is unpaid at year end, it is a current tax liability. If you have overpaid, it is a current tax asset. There is no judgment here. It is arithmetic on the tax return, not an estimate. Current tax is measured using tax rates and tax laws enacted, or substantively enacted, by the end of the reporting period, the same enactment test deferred tax uses. And if a loss can be carried back to recover tax already paid in an earlier period, that recovery is itself a current tax asset, recognized in the loss-making year, not the year the refund arrives. Deferred tax starts with two numbers on the same asset or liability. Its carrying amount in your accounts, and its tax base, what the tax authority will let you deduct against it in future. The gap between them is a temporary difference. A taxable. Temporary difference means you will pay more tax later. A deductible one means you will pay less. IAS 12 treats those two directions completely differently. A deferred tax liability is recognized for almost every taxable temporary difference, full stop. A deferred tax asset is recognized only to the extent it is probable that future taxable profit will actually be available to use it. Same standard, one asymmetric test, prudence built directly into the recognition rule. Two exceptions sit right at the start of that rule, and one of them just changed, the initial recognition exemption. No deferred tax at all where a transaction is not a business combination, and, at the time, affects neither your accounting profit nor your taxable profit. And a permanent exception on top of it. A deferred tax liability is never recognized on the initial recognition of goodwill itself. But that exemption was narrowed. Since the 1st of January 2023, it no longer applies where a single transaction creates equal and offsetting taxable and deductible differences at the start. The classic case being a lease liability and its right of use asset, or a decommissioning provision and the asset it relates to. You now recognize the deferred tax asset and liability gross, even though the net effect on day one is zero. Investments in subsidiaries, associates, and joint ventures carry their own version of this. A deferred tax liability on the parent's share of undistributed profit is recognized, unless the parent controls the timing of any reversal. And it is probable that reversal will not happen in the foreseeable future. Two conditions, both required before you can avoid it. Recognition decides whether a number exists at all. Measurement decides how big it is. And which rate to use is its own judgment. Deferred tax is measured at the rate expected to apply when the asset is realized or the liability settled, using rates enacted or substantively enacted by year end. And deferred tax is never discounted to present value, even though settlement can be years away. The rate in the tax base you use must match how you expect to recover the asset, through use or through sale, because some jurisdictions tax the two differently. IAS 12 goes further for one specific case, an investment property held at fair value under I, as 40 is presumed to be recovered through sale, unless it is depreciable and held to consume its benefits over time. That presumption alone can change which tax rate applies. One more principle before the numbers. Tax follows the item it relates to. Tax on something recognized in profit or loss is recognized in profit or loss. Tax on something recognized in other comprehensive income or directly in equity is recognized there too. The tax entry never travels to a different statement than the transaction that caused it. Enough principles. Let's put real numbers through all of it, start to finish. Meridian Limited, accounting profit before tax, 2 million euros. To get to taxable profit, add back 300,000 of accounting depreciation, since it is not itself deductible. Deduct 500,000 of tax depreciation, the amount actually allowed. Add back 150,000 of warranty costs accrued but not yet paid. And deduct 50,000 of non-taxable government grant income. Taxable profit, 1,900,000. Current tax at 25%, 475,000 euros. Now deferred tax on the same two items. The equipment's carrying amount now sits 200,000 above its tax base because tax depreciation ran ahead of accounting depreciation, a taxable temporary difference, giving a deferred tax liability of 50,000. The warranty provision has a tax base of 0, since none of it is deductible until paid. The full 150,000 is a deductible temporary difference, giving a deferred tax asset of 37,500. Put the two together, and the number should tie out exactly to the accounting profit times the tax rate, minus whatever doesn't belong in tax at all. Current tax, 475,000. Net deferred tax expense, the 50,000 liability less the 37,500 asset, 12,500. Total tax expense, 487,500. At the standard rate, 2 million times 25% should give 500,000. The gap is exactly 12,500. The tax effect of that 50,000 euro non-taxable grant. Nothing else moves the total. Every temporary difference washes out through deferred tax by construction. Effective tax rate, 24.38%. Meridian's actual statement. Profit before tax, 2 million. Current tax, 475,000. Deferred tax, 12,500. Total tax expense, 487,500. Profit for the period, 1,512,500. Every euro traceable to a paragraph and to the reconciliation that proves it. 4 things to carry into Part 2. Current tax is this year's bill. Deferred tax is what today's numbers commit you to later. Recognition is asymmetric. Liabilities almost always. Assets only if probable. The initial recognition exemption no longer covers leases and decommissioning. And tax always follows the item it relates to, into whichever statement that item landed in. That's how the machine works. Part 2. Where deferred tax actually comes from? Revaluations, pensions, share schemes, group accounts, and the global minimum tax rule the IASB had to build a special exception for. See you there.